Hi there, this is Dan McLaughlin. I'd like to welcome you to one of my periodic updates on the Irish residential property market as it stands at early June 2015. In this chart we see the trend of Irish house prices nationally as recorded from the CSO index. Prices in fact fell about 50% from the peak and bottomed out in March 2013. But as the chart shows, this is a year-over-year change in prices. We've seen quite a strong recovery over the last couple of years. Currently prices are up around 16% from a year ago, and in total we've seen a 27% increase from the cycle low. That recovery was certainly not even across the country, however, and in this chart that's very clear because we can see the change in residential house prices in Dublin and the change elsewhere in the country, and you can see clearly that the capital has outperformed significantly, although of late it is clear that the rest of the country has picked up a little bit and the gap is narrowing somewhat. That recovery in the market is also very evident in terms of residential rents, and in this chart we can see the annual change in rents across the country, and of late the annual increase has been around 8 to 10%, and indeed now rents are 27% up from the cycle low and are now just 5% below the all-time high. So the implication is pretty clear that combination of rising prices and rising rents would suggest that the demand and supply balance for housing is certainly tightening. The residential rental market in Ireland is also likely to be affected by macroprudential controls introduced by the Irish Central Bank in early 2015. There are two controls, one relating to loan to income with a figure of 3.5 times, with 20% of loans allowed above that ceiling. In addition, there is a control in terms of loan to value with a maximum of 80%, although 15% of loans are allowed above that ceiling. The decision to bring in the controls prompted a lot of debate in Ireland, and there was a concern that it would have a big impact on first-time buyers. So the central bank changed the regulation slightly from the initial indication, and in terms of first-time buyers, the loan-to-value limit is 90%, up to a mortgage limit of $220,000. The implication, though, I think, is that people will now have to save for a longer period than would otherwise be the case, and therefore, by implication, probably be renting for a longer period, which is likely to put further upward pressure on residential rents. The housing market will obviously also reflect broad conditions in the economy, and in that sense the Irish economy has picked up significantly in the last couple of years, and we've also seen a significant improvement in the labour market. In this chart we see the total number employed in Ireland, which peaked in late 2007 at over 2.1 million and subsequently collapsed by around 325,000 or 15%, but down to a low if recorded in the middle of 2012. As we can also see from the chart, employment has picked up steadily since then and has risen by around 110,000 or 6% since that cycle low. The unemployment rate has benefited as a result and is now down to under 10% from a high of 15.1%. That improvement in the Irish labour market is also feeding through to a better tone in terms of disposable income. In this chart we see the annual change in Irish household disposable income, and you can see clearly that income collapsed particularly in 2009 and 2010, but from 2012 we've seen some very modest gains. That is certainly supportive of the housing market in general. That improvement in Irish household income alongside the decline in the unemployment rate in particular, is beginning to have an impact in terms of mortgage arrears. The percentage of mortgages in arrears in Ireland is extremely high by international standards, but does seem to have peaked. That is, I think, particularly true for the mortgages in terms of personal dwelling homes, where at one point 12.5% of outstanding mortgages in that sector were in arrears, but that has now declined to just over 10%. The change in terms of the buy-to-let market is less pronounced, but again looks as if it may have peaked, but is still around 21%. So in total, there's 108,000 mortgages in arrears if you add the two markets together, but that is down from a peak of 130,000. The pace of house price appreciation of late, particularly in Dublin, I suppose raises the question of whether the market is now expensive or not. And in fact, on a number of metrics, it still looks as if that isn't the case. In this particular chart, we look at affordability, which we define as the cost of servicing a new 25-year mortgage relative to income. As you can see, over the last 40 years, we've had periods in the 1980s, for example, and particularly in the mid-noughties when affordability had deteriorated very sharply, and in other periods like the early 90s and in the last few years where affordability looks very comfortable. In fact, affordability right now is the best it's been since the late 1990s, or around 18 years. So on that metric, it certainly doesn't look as if house prices are particularly expensive right now. Another way to gauge house prices is to compare the price of an average house in Ireland with the average rent. And in this chart, we look at that ratio, house price divided by rents, or going back to 1996. And over that period, the average is 21. In other words, a house price is 21 times annual rents. And you can see also that at times house prices have risen significantly relative to that long-term average, particularly in the mid-noughties. Since then, of course, house prices have fallen from 2007. And of late, of course, rents have started to rise significantly. So as a consequence, we're now in a situation where that house price to rent ratio is well below the long run average, again signaling that house prices don't look particularly stretched on that kind of metric. The improvement in the economy and the pickup in employment would suggest that we should be beginning to see a better environment in terms of mortgage loans. And of course, the Irish banking sector is also in a better position to supply additional credit. And indeed, that is we can see from the chart here that new mortgage lending has picked up. This is new mortgage lending for house purchase on a quarterly basis, and it is quite seasonal, so what we've done is put in a 4-quarter moving average just to give a better indication of the trend. And you can see quite clearly that over the last while that mortgage lending is beginning to pick up. It's now coming in at well over 5,000 a quarter. So last year, in 2014, the annual figure was around 20,000, and this year it's obviously going to be higher than that. To put it in context, though, at the peak of the boom, there was 110,000 new mortgages granted for house purchase. So, although we are seeing very significant percentage increases on a year-over-year basis, we are coming from an extremely low base. So we can see that new mortgage lending is certainly rising, but one of the interesting things about the market right now is that it's clearly not credit driven. We can see this from this chart, which shows Irish residential transactions on a quarterly basis. And what we've done here is superimposed the number of mortgage drawdown for house purchase for that same quarter. And in general, over the last couple of years, Irish mortgages have accounted for, it would seem, less than half of transactions. And again, going back to, let's say, a more normal environment, you'd expect mortgages to be accounting for 80 or 85% of transactions. So clearly, right now, the market is certainly not driven by credit, and there seems to be a significant amount of cash purchases. One of the other features in terms of mortgage lending is the fact that although new lending is picking up, the amount of debt repayment is actually very significant in Ireland. In other words, Irish households have been deleveraging now for around 6 years. And we can see from this chart, this is the total amount of debt that Irish households have from the banking sector. And you can see that it peaked at well over 200 billion, or over twice, well over twice household disposable income. But there's been a steady repayment of debt, and in fact household debt has fallen by 47 billion over the past 6 years, and is now just over 150 billion. So this combination of some improvement in new mortgage lending, but offset by significant ongoing deleveraging, means that the outstanding amount of mortgage credit has been contracting now for the past 5 years. And this chart shows you the year-over growth in mortgage credit over that period, and you can see that trend doesn't seem to be showing any significant inclination to change. And we have the latest data, in fact, from April, showing still mortgage lending declining by 2.6% year over year. The market would therefore not seem to be driven by credit, and the pickup in house prices and the stronger rental market would clearly seem to be driven by just an improvement in the demand for housing, which is now outstripping the supply. And if we turn to the supply side of the market, this chart shows you the annual house build in Ireland going back over the last 10 years or so. Obviously in the noughties we had extremely strong house building figures, and then we see the collapse during the recession. House building bottomed in 2012 and has picked up since. We've seen very strong percentage gains in the last couple of years. For example, in 2013 there was just over 8,000 houses built, and 2014 it jumps to just over 11,000. And I suspect in 2015 it'll be around 14, possibly even 15,000. So very strong percentage increases, but to put it in context, most analysts, including the ESRI, believe that Ireland will require something of the order of 25,000 houses per annum to meet demand. So even with the strong percentage gains we've seen in the last couple of years, Irish house building does seem to be still significantly lagging the perceived annual demand, which does imply that absent some significant demand shock, which is always possible, of course, particularly in the international environment, but absent such a shock, house prices are likely to continue to increase. That imbalance between housing demand and supply is also very pronounced in the capital. Most analysts, again, believe that Dublin will require something of the order of 7,500 housing units a year to meet demand over the next 5 to 10 years. But supply is certainly well short of that at the moment. This chart shows you Dublin house completions over the last few years, and you can see there has been somewhat of an improvement. If you look at 2013, there was around 1,500 completions in Dublin, meaning Dublin City and County. And 2014, that had risen to 3,300. I've also broken down the completions in terms of how many of those are actual houses as opposed to apartments. But despite that improvement, it still implies that we're significantly short of the 7,500 total. So in conclusion, I think the evidence points to the fact that the Irish housing market is in much better shape than it's been for many, many years. Rents are rising across the country. House prices are appreciating, with that pace of appreciation very pronounced in the capital, which also suggests that demand for housing is strengthened and that it's significantly outpacing supply. Supply is increasing, of course. We have seen a pickup in house completions, but I think both nationally and in Dublin, the pace of house completions is still significantly shy of the kind of figures that most analysts believe are necessary to bring supply in line with demand in the medium term. I think we can also say that it's certainly not a market driven by credit. New mortgage lending has certainly picked up, and we've seen very strong percentage gains, but it's coming from a very low base, and the fact that over half of transactions seem to be driven by cash is also indicative of a market where credit is not playing a huge role. Also, we can say that deleveraging by Irish households is still very pronounced, and as a consequence, net mortgage lending is contracting. So overall, I think the implication is that we're likely to see further house price appreciation and further growth in rents, absent a demand shock. That's always possible, of course, and it does look as if the government may try to intervene in terms of the rental market, but any intervention which effectively dampens supply and increases demand can obviously only make the rental imbalance even more pronounced. Thank you for your attention, and if you're looking for any further information on the market or like to comment or contact me, please visit my website www.danmclaughlin.ie. Thanks for your attention.